Good evening, everyone. I hope you're doing well. I wanted to look at some real world numbers, the actual profitability of the Australian mining sector, the return to investors. What did investors actually get? Keeping it's because there's a lot of talk in Australia at the moment, about taxing the mining industry more, whether it's the 25% gas export tax or these calls that they're profit the miners in Australia are profiteering from the Iran war. They make these mega profits. The mining companies are rich. They can pay more, etc., etc. Well, what's the actual real world return? And the real world return is to the shareholders. I mean, BHP, Rio Tinto, Woodside Energy, these are artificial entities. BHP is not a person that keeps profit and goes and buys a sports car or goes on a fancy overseas holiday or buys a new house or something. The profit goes to the shareholders, which includes your superannuation fund. Your superannuation funds are heavily invested in stocks, shares, companies, including Australian mining companies. So when you talk about taxing the mining companies more, you're not talking about taxing the employees of the mining company or the contractors, the people who the mining companies, they pay mining services companies, or they might buy electricity or buy raw materials or something. You're talking about taxing the company, which is the same as taxing the shareholders. The shareholders, including your superannuation fund, are the company. That's what you're talking about taxing. So let's have a look at the real world return, not some bullshit number from an Australia Institute news article quoting, oh, they made all this money, not some accounting entry. What did you actually earn as an owner of the company? What was your share of the profit? And what I've done here is I'm using ShareSite, which is a portfolio reporting service that a lot of financial professionals use. And what I've done is back in 2011, prior to that, you would have to you'd pick a company, you'd buy shares in BHP, or you would buy shares in Rio Tinto or something, but you couldn't buy the whole industry unless you went out and bought every stock. So ETFs were launched, and in 2011, State Street Investment Management launched OZR, which is an ASX 200 resources ETF. And what this does, it allows you to buy the entire, well, it essentially buy the Australian mining industry. Now, it resources are companies that are classified in the energy sector, metals, and mining. So essentially the mining industry. Now, no measure is going to be perfect, but this is a real world investment that you would buy on in April of 2011. So what I've done here is I assumed that I bought it on launch day on let me just double check what date that was. The 14th of April 2011, I bought $10,000 worth in this hypothetical portfolio. And we can see OZR here, 1485. So over the past 15 years, since April 2011, if you put $10,000 into the Australian mining sector as an owner of those companies who receives profit, either in the form of capital gain, I'm counting all the capital gain, the share price growth, and I'm counting all the dividends. So the profit share, if you want to call it that, the income, the dividend payments to shareholders, keeping in mind that a lot of people would still have to pay income tax on those dividends they've received, not necessarily a super fund. It depends if they're franked or not. That's a separate topic. We can't tinker around the edges too much there, but let me just get back to it. You made $8,550 of return. Now that calculates out to over 15 years, and let me just go to the performance. You made a 5.69% return per annum. Less than 6% return per annum, investing in the Australian mining sector for 15 years. And that includes, I'm taking it from today's prices. So the mining sector has had a massive run up in the last 3 to 6 months, right? If I measured this 6 months ago, the return would be negative. It'd be zero, just about, if I cherry pick dates. I'm not cherry picking dates. I'm including all the Iran war pump, all the mega profits that the Green Party's telling you they're making. I'm including those in this calculation. All right. Now, what would happen if you just invested in the entire Australian market? So if you bought Vanguard VAS, which is just a fund that owns the top 300 companies on the Australian market. So you're just buying the ASX 300, right? What would your return have been? Well, if you put $10,000 in on the same day, on the 11th of April, 2011, you would have made a total return of $17,549. Double the return of the Australian mining sector. right? And keep in mind, VAS owns miners. So the miners would have dragged down the overall return in VAS. So if you took the miners out, the return would probably be 20 grand. So the rest of the Australian market, so the banks, CSL, Coles, Woolies, retail companies, everything else on the Australian market made more than double the return of the mining industry for the people who actually own the companies, which are the shareholders, right? Gets way worse than that because if you had invested in the US market, right? So if you just bought, again, these are funds that I'm not recommending any of these funds, by the way, I'm just using them as a benchmark. VTS owns the US total market. So all it does is you just bought the US stock market, all the companies on the US stock market. What was your return compared to the Australian mining sector? If you had invested $10,000 in the US stock market as an Australian investor, buying it on the ASX, you bought it on your mobile phone app, or well, I guess there might not have been an app back then, but you bought it on your ComSec trading account, you would have made $73,748. That's how much the US stock market has gone up. We're talking 8 to 9 times the return of the Australian mining sector over that period. Right now, this is not an arbitrary. I didn't cherry pick a date. Yes, I will acknowledge that in 2011 the mining sector was at a bit of a peak. So let's take that into account. But I didn't cherry pick a date. I just picked the date that this fund was launched. Right, the U.S. market. Look how much better the return was buying the US market on the same day. 73 grand return versus $8,500 return. So how profitable is the Australian mining industry really? You hear these big numbers, but keep in mind it's a massive, massive industry with shareholders all over the world. Everyone's got to get their little slice of that pie, right? And once you slice it all up, you hear, oh, BHP made billions and billions in profit. Yeah, that's got to be sliced up amongst many, 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 many people, many of your super funds, right? So now I'm going to cherry pick things a bit more because Santos obviously cops a lot in the media. From the Marxists on the environmental Marxists on the left that want to hypertax. Our friend Punter's Politics, for example, he makes his little mockery of Santos with the stickers and tax Santos and they don't pay any tax. Well, how would you feel if you were an owner of the company, right? If Santos was your business, like owning shares in a company is not that much different from, you own a cafe or a restaurant. All the shares do is allow many thousands or millions of people to own a piece of the same company. Santos peaked. Now, this chart is a little misleading because Santos actually peaked at $21 a share, but what they did was a share split. So my charting software adjusts the price down so we can track actual performance. But Santos, the share price is down, even with all the share splits. So it was actually at $21 a share. It's down 54%. So if you bought at the peak in 2008, you put 10 grand in, guess what? You've only got $4,600 of your money left. Now, you did get some income, but nowhere near enough to make up it. Now, the price is the same. Look at this chart here. This is today's price. Santos is the same price as it was in April 2005. 21 years, not adjusted for inflation. You put 10 grand in 21 years ago, all you've got is 10 grand. And what did you get during that time? Santos pays an average over the last 15 years. I only went back 15 years, but if someone wants me to go back longer, please let me know. The dividends are only 1.56% per year. That's less than what you get if you put the cash in the bank. If you put your 10 grand in the bank 15 years ago, you would have made more than 1.56% in interest per year, and you'd still have your 10 grand. Meanwhile, you've put this money into Santos, you put in $10,000 in June of 2008. And guess how much you have now, including all the income payments, right? You've lost 2% a year. These are per annum returns, right? You lost 2% a year and you're down, not adjusted for inflation. You've lost $3,671, including after collecting $2,787 in income payments. You're down. You've lost money. How can you be advocating taxing this company more when the shareholders of that company over a significantly long period have lost money? Now, yes, there are times when you could have bought it. If you were smart enough to buy at the low in 2016 after the price had declined 86%, okay, you're up. You made 210%. What did the US market make during that time? You know, what did other industries make? And this is buying Santos on its own would be a very, and again, I'm not recommending any of these investments, but it's risky to buy one individual company. There's more volatility versus buying the entire industry. So um, Now, I understand if you picked the low of the, so the mining sector had a massive, massive bottom in, and let's have a look at BHP because BHP is the largest mining company, I believe the largest mining company on the planet. Someone fact check me on that, but it's certainly Australia's largest mining company, and I believe it's the largest diversified miner on the planet. I don't know if that counts, like in Qatar and Saudi Arabia, where the government owns a lot of the infrastructure. I don't know if that's counted as part of who's the biggest. But in terms of private company or public companies that like regular companies that are not owned by government entities, BHP is love. So have a look at this. This chart goes back to, well, this is the year 2000. In August of 2025, BHP was $36 a share. The same price it was at in 2007, right? So you went almost 20 years, you put 10 grand in, 20 years, your money went nowhere, right? Now, yes, if you're smart enough to trade it, there are times when you can buy, and look where it is. Look at how high BHP is right now. It's very close to an all-time record high, and that was included in all my calculation here because OZR has a massive hold. Have a look at it. Let's have a look at OZR, right? The holding in BHP. Let's scroll down. Now, this has changed over the years, but 36% of OZR is BHP because BHP is such a large company, right? So when I quote this performance, this $8,550 return over 15 years compared to the 8 or 9 times larger return in the US market, that includes BHP being up at this price and all the capital growth that investors have enjoyed in BHP's share price, especially over the last sort of 6 months or so, or 6 to 9 months, where it went up 60%. That's included in the number, right? Now, yes, if you had bought the mining sector low in March of 2016, you would have outperformed the rest of the Australian market and potentially the US market. I didn't do that calculation, but I'll concede that point for this video. But like any stock, if you're trading it, you can always cherry pick a absolute bottom to buy the stock at. And of course, in 2011, yes, there was so we can see BHP peaked in April of 2011, which is where that fund launched, where my calculations started. But keep in mind, that peak was the same as 4 years earlier in 2007. So if that fund had existed in 2007, or there was no return there for 4 years as well, no capital growth. Yeah, you got a little bit of income, but no more than you would have got cash at bank, and certainly not to make up for all the inflation we've experienced. So, yeah. Anyway, if someone wants to, if you'd like to comment and see other time frames, I understand I've picked some select time frames, but these are long time frames. I'm not picking a 6 month time frame and saying, oh, well, look at how little profit was made in 6 months. I mean, these are 10, 15, 20-year time frames. If you go back and look at Woodside, our largest oil and gas miner. Everyone wants to tax the gas miners, right? Let's have a look. Woodside peaked in 2008 up at $68 a share. Look at where it is today. It's down 50% in price, meaning, and even with the spike up on the Iran war, that's the red candle is where the price closed at today, right? Let's draw a straight line back, and you can see Woodside, our largest oil and gas miner, the same price as it was in July of 2005, almost 21 years ago. Zero capital growth, right? Zero. Now, Woodside has paid some dividends, but again, the dividends are not, they don't make up for the massive underperformance relative to other sectors. And sorry, there was one more that I forgot to mention, and that's OZF, which is the Australian Financial Index, which would be heavily dominated by the banks, some smaller banks and insurance companies, etc. I believe there's actually no real estate in there, so it's just banks and financial institutions. So that could include some insurance companies, right? So again, look at the performance. If you had bought the banking industry in Australia at the same time, you would have made your 10 grand would have produced a $22,636 return compared to the $8,500 return in Australia's miners. And let's have a quick look again, OZR. You can see the performance comparison. And if I take this off and I go add benchmark and I go OZF, which is the financial fund that you could buy on the Australian market, have a look. There's your miners and there's your banks, your financials. Massive outperformance. So again, where is this coming from suggesting that the Australian mining sector is super rich, making mega profits? The shareholders aren't getting it. Where's it going? The answer is it's not going anywhere. It's a lot of it is, I don't want to, maybe I'm using the word propaganda too strongly, but I'll wrap it up there. But just have a look at some of the real world data and ask yourself, you know, if you tax these companies more, or if we, a lot of these advocates of higher taxes on the mining industry are talking about, oh, if we taxed them at this rate for the last 5 years, would have got this much revenue. Well, if you had taxed, like for example, that gas export tax, 17 billion a year, they're estimating it would bring in revenue. Well, that's $17 billion less that would go to the shareholders. So what would that do? What would that have done to the shareholder return? If the return is this low relative to the US market, relative to the overall Australian market, and relative to other major sectors like our banking sector, our financial sector, which is a big sector in Australia's economy due to our real estate mega hyper bubble, if you had taxed the mining industry more, but that $8,500 return, there might be zero return. You might have had 15 years of zero return, because any additional tax you're applying to the miners, it's coming from the shareholders. 25% gas export tax doesn't apply to the workers of the employees at Santos and Woodside or any other gas export company. It applies to the corporation, to the shareholders. It takes return away from the shareholders. And imagine how much more the prices of our mining companies like Woodside, which has gone nowhere in price over a 21-year period. Yes, there were times where it was high. Yes, there are times when it was lower, but it's the same price it was 21 years ago. Where do you think the share price would be if for the last 10 years we had applied a 25% gas export tax? Don't tell me it would be the same. It would absolutely be lower. So just take into account these real world numbers. And if you'd like to fact check me, or you'd like to ask about another specific company or a specific time frame, I'm happy to look at that. And I'm also happy to acknowledge that yes, you can select time frames where the mining industry has outperformed. But what about the risk? What about the risk of seeing, in the space of, from July 2008 to, 9 months later, you can lose 55% of your capital. You need to get a return when, when you're taking that much risk. I'll wrap it up there. If you made it this far, thank you so much for watching. Talk again soon. Cheers.